I would like to talk about, not surprisingly, is the ECB's monetary policy since 2014. So this talk will be mostly backward-looking, trying to, one, explain why the ECB took the very comprehensive package of easing measures starting in 2014, spring of 2014. Secondly, we'll try to convince you that these measures have been effective in a variety of ways in terms of stimulating the economy and bringing back the inflation on a path that is compatible with our price stability mandate. And then at the end, I will say a few things about current labor market developments and the fact that we're not there yet fully, and so some patience and persistence is needed. Now, I don't think I need to remind this audience about what the objective is of the European Central Bank. I mean, that is very much written down in the Maastricht Treaty, the Treaty on the European Union, which says that the primary objective of the ECB shall be to maintain price stability. Very clearly, our main objective is to maintain the purchasing power of our currency, of the euro. We shall also support the general economic policies in the Union, but very clearly without prejudice to the objective of price stability. So there cannot be any compromise there. Now, what does that mean, maintaining price stability? And early on, a few months before the start of EMU, our governing council, the decision-making body of the ECB, defined price stability as a year-on-year increase in the harmonized index of consumer prices for the euro area of below 2%. And also make clear that price stability is to be maintained over the medium term. I mean, obviously, there are lags with which monetary policy can affect prices, and one has to take into account those lags, and so price stability has to be maintained over the medium term. Now, in May 2003, so well before the current financial crisis started in 2008, 2009, the Governing Council clarified this definition. This was under the guidance of Professor Otmar Issing at that time, who was the chief economist of the ECB. And it clarified that the Governing Council aims to maintain inflation rates at levels below, but close to 2% over the medium term. So that's the main difference in the clarification. The Governing Council basically, after quite a year of analysis, so to say, thought it was important to maintain a bit of a buffer. So it aims at something that's closer to 2 rather than to 0. For two main reasons, and of course they sound very true now looking back at the crisis. The first reason was that, of course, the Governing Council realized that our monetary union is still a very heterogeneous union where relative price and wage developments have to work. Some countries may lose competitiveness, have to gain competitiveness by having lower inflation than in other regions that have gained competitiveness and have to adjust. Now, that's easier if you have a little bit of inflation that sort of greases the wheels. Why? Because typically it's much more difficult to bring wages down. There's so-called downward nominal wage rigidity than it is to bring wages up. And so if you have a little bit of inflation, something close to 2%, that provides a buffer whereby countries and regions in the monetary union that need sort of a downward relative price adjustment, that need to gain competitiveness, can do so without going negative, without having deflation in their region. So that was the first reason. And the second reason, and of course we know one of the reasons for the crisis or the problems of adjustment in Europe was the need to gain competitiveness in particularly some of the southern countries of the euro area. The second reason was to create some buffer away from what's called the zero lower bound on interest rates. We all know that because of the presence of cash and the ability for households, firms to turn into their investments, their deposits into cash, it's not that easy to bring interest rates way below negative, below zero. Now, nominal interest rates, the nominal interest rate level, of course, is determined also by the objective for inflation because of the Fisher relationship. No? When inflation is a bit high, then nominal interest rates will be higher. And so the room for maneuver to lower nominal interest rates when the shock happens is bigger when the steady state nominal interest rate is higher. So that was the second reason why the Governing Council decided in 2003 to maintain this little buffer. And at that time we did lots of studies to show that the adjustment of monetary policy at this 2% level was less costly in the response to negative shocks than otherwise would be the case. So price stability, but with a little buffer of close to 2% over the medium term. Okay, so how have we done? This is our main key performance indicator. So this is the headline HICP index, that's the blue line here, since the start of EMU until most recently. The most recent number for the headline is 1.3% here. So if you look at the period before the start of the crisis, more or less we were relatively close, around 2%. Actually, if you would take the average over this period from 1999 to 2008, you would get, the former president of the ECB used to boast about that, you would get a 1.99%, so very close to 2%. The red line gives you the HICP index excluding food and energy. It's a bit lower over this period because over that period energy prices, energy price inflation has been relatively higher than 2%, and so the rest of the index is somewhat below, but it's again close to 2%. Then there's quite a lot of volatility when the crisis happened, mostly related with volatility in energy prices and oil prices in particular. But what I want to talk about is basically this period. So what happened in the beginning of 2014, as a result of the sovereign debt crisis and the double dip recession that we had in 2012-2013, not only headline inflation fell precipitously, then eventually reaching zero, but also inflation excluding food and energy prices fell below 1%. So that's the situation we're facing in terms of what is our mandate and our objective in the first half of 2014. Now this you have to combine with the fact that in the spring of that year, basically the economic outlook, which had been sort of going up, started to deteriorate. So this is maybe not an easy graph, but so let me just explain it. Basically, it shows forecasts or estimates of growth in 2014, starting in January 13 until January 15. So it's the change in the forecasts of growth for 2014. This picture does the same for 2015. And so what you see is that in the spring of 2014, these forecasts started going down. So there was a slowdown of the economy. This is an environment where inflation was already relatively low and headline inflation was heading towards zero. And so then the natural question for a central bank is, okay, what can we do in order to bring inflation back and to ensure that inflation expectations and actual inflation stay around 2%. Now, why was this not an obvious question? Normally, central banks would just lower nominal rates. That way, lower easing financial conditions that would stimulate the economy, that would steer against these negative confidence factors, bring back the economy, and stabilize inflation. That would be the normal reaction. But of course, at that time, there was not much room for maneuver anymore, because these are basically our corridor of policy interest rates. The deposit rate was already at 0. So the way we steer short-term interest rate is through this corridor system, where the bottom is determined by the deposit rate. This is the rate at which banks can deposit with this central bank. At that time, this was 0%. And the upper band is given by the borrowing rate. That is the rate at which banks can borrow funds overnight against collateral at the ECB. So that was at that time 75%. And the market rate is basically in between this corridor. Usually, in normal times, it's, usually in normal times, it's basically in the middle of the corridor, because the bank will give as much liquidity as the system in the aggregate needs. What of course has happened with the response to the Lehman crisis is that the ECB started to do full allotment and basically give whatever liquidity banks needed to address the turmoil in the money market. So given that banks no longer dealt with each other, the ECB stepped in as sort of market maker of last resort. And this led to a situation of excess liquidity. When you have excess liquidity, basically the market rate will be bumping at the bottom of this corridor. And so that was the situation then. So in the beginning of 2014, or the first half of 2014, we have a period, have a situation where on the one hand, inflation, both headline inflation and underlying inflation, and one measure of that is inflation, HICP, with excluding food and energy prices, was dropping and dropping relatively rapidly to a zone where we would not be comfortable anymore, against the background of an economy and a growth rate that was relatively fragile, not very broad-based at all, and deteriorating, and a situation where the space for additional policy stimulus through conventional measures, that is lowering of the short-term policy rates, was limited, because we were sort of already at 0. And so that's where the non-conventional monetary policy measures came in. And this is true, this rationale for the use of non-standard measures, non-conventional policy measures, is true at that time, but was also true earlier in the crisis. Basically, there's two reasons why a central bank may want to revert to non-standard measures. I mean, the first one already discussed. If you no longer have much room for easing standard monetary policy because you're close to the zero lower bound or even below the zero lower bound, then of course you may want to consider other measures like buying asset purchases directly, and that way bringing down longer term interest rates, pushing up asset prices. There's another reason, which also in the first and the second stage of the financial crisis the ECB used, but with different measures, that is to address impairments in monetary policy transmission mechanism. So it's one thing to lower your rates and hope that this will stimulate the economy, which is usually what will happen by reducing financing costs, stimulating consumption and investment. It's another thing if you see that actually the pass-through from the very short rates that you control to the longer rates is not happening. And this was the third thing that was clear at that time. So these are sort of the general rationale for using non-standard measures. And what I want to do in the next few slides is just give you the application of that general rationale to the particular situation as we faced in 2014. And to some extent, President Draghi, in a speech in Amsterdam on 24th of April 2014, so this was before the decisions on this comprehensive easing package, had already pointed out the ECB's reaction function by laying out 3 contingencies that would lead to 3 types of actions. The first one is lowering the interest rate corridor, including a negative deposit rate. The second one was longer-term refinancing operations targeted towards encouraging bank lending or an ABS purchase program. This was mostly seen as an action in response to impairments in the transmission of the policy stance, in particular via the bank lending channel. And a third contingency, which was the worsening of the medium-term outlook to inflation, as I've just described, leading to a more broad-based asset purchase program. Now, unfortunately, as we now look back over the past 3 years since, a little bit more than 3 years since this speech, each of these actions we had to take because basically each of these contingencies became true. And just let me give you 2 particular sort of slides to try to convince you that this was the case. This is about the pass-through. What this graph shows, we've shown this in the monthly bulletin or economic bulletin a number of times, is how changes in the policy rate, which are typically changed in steps, no? So these are changes in our corridor system, pass through in bank lending rates. And this is the gray mass. And the gray mass, basically, the width gives you differences across countries, right? So there's some differences, but more or less you have a one-to-one pass-through from short rates to bank lending rates, which is really what matters for investment and consumption, particularly in the euro area. So this is the usual pass-through, and here I took as an example the 2002-2003 easing cycle, just before the crisis. This is what we saw following the post-OMT easing cycle. So of course the drop was a little bit less, but what you can see is that there are a number of countries where there was no pass-through at all. Basically, our monetary policy easing did have no impact on bank lending rates in those countries. This is what we call impairment in the transmission mechanism that we need to address. Now, in normal times, the central bank can react by lowering the short rate further in the hope that at least there will be some pass-through and bank lending conditions will fall. In this case, this was not easy because, again, rates were already low. So, but basically it's part of the measures that we took, and particularly the targeted LTRO, the lending operations to banks, were specifically addressed to this particular impairment. The second graph I want to show is just an exercise based on so-called Taylor rules, central bank reaction functions. I mean, probably it would take me too long to explain exactly what is done here. But to be short, what we do is, and this is a so-called thick modeling approach. One of the things with Taylor rules, with estimated reaction functions, there's lots of uncertainty. And so, because you have to measure the output gap, you have to measure the equilibrium real interest rate, you have to estimate the relationship. And so what we do here is we estimate hundreds of reaction functions with different measures of output gaps, different measures of inflation expectations, backward-looking, forward-looking, fit such a reaction function to our interest rate before the crisis. And you see the fit of all these rules is not bad. No? So you can explain why before the crisis we raised interest rate, lowered and raised it again on the basis of what's happening to inflation, inflation expectations, and output, economic activity, and output expectations. And then we project that rule, which is sort of our normal reaction function, I guess, under different specifications, through the crisis. And this is what you get. This is the dark line is basically the median of all these projections, because we've estimated literally, I think, almost hundreds of those things. And then there's the uncertainty around it, and compare it with the actual short rate, the year-on-year rate, as was said. And the only point I want to make is, well, there's 2 points. So first of all, you have to be careful with these reaction functions because there's a lot of uncertainty, right? So there's a lot of uncertainty depending on which rule you take. So one has to be careful to become a slave of any specific rule. But the second point I want to make is that in the beginning of 2014 was a period when actually there was a significant difference between our interest rate, as it was set, and the sort of range of interest rates that would have been predicted by this set of reaction functions. And again, this is just to make the point that given what we saw in the economy in terms of inflation, inflation expectations, economic activity, these reaction functions in normal times, estimated in normal times, would have suggested that we should ease policy more. And of course, that's where, again, the monetary easing package comes in. Okay, so this is where, this is probably not readable, but maybe the colors help. This is a timeline starting in January 2014, ending in 2016, and it gives you an overview of all the actions we have taken at the ECB. The blue boxes give you the decisions when we decide to go into negative territory with the deposit rate. Now, because it is uncharted territory, usually central banks often take 25 basis point steps when they changed. We took smaller steps, as other central banks had been doing, of 10 basis points. And we did it in 2 parts. No? So the first one was basically the second half of 2014, twice 10 basis points. And the second wave of easing was towards the end of 2015. This is after the major, very significant slowdown of global growth in that period, which again was sort of a negative shock. So that's the sort of uncharted territory of negative interest rate policy, bringing the deposit rate to minus 40 basis points. Then the green parts are the TLTROs. So we had 2 waves again of targeted long-term refinancing operations. So what the ECB then does, in order to sort of ensure that our policies truly get translated in bank lending conditions, we lent directly to banks, relatively long horizon. It was a little bit different, but in the order of 3 to 4 years, at cheap conditions, basically being the MRO, our main refinancing operation rate, but under the condition that banks actually use that money to lend to non-financial corporates. And again, we had 2 waves. One was in the second half of 2014, and the other one was in around the turn of 2015, 2016. And then the third part of this comprehensive easing package is the orange part here, which is the direct purchases of securities. And the red parts are sovereign bonds, the yellow parts are private sector bonds, so covered bonds, corporate bonds. And again, you see sort of two waves in these 2 sort of easing cycles. So obviously I don't have time to go into the details of each of those measures. What I want to show you that first of all it was a comprehensive package, sort of consisting of each of these 3 parts, and I want to make the case that actually these components were complementary and helped to reinforce each other in their effects on the economy. And secondly, there were sort of two waves. No? There was first the easing after April, May, which is for the reasons that I had shown. And secondly, the easing again towards the end of 2015, which was mostly a response to the slowdown in the global economy. Of course, the last action was in December 2016, when we recalibrated the asset purchase program from 80 to 60 and lengthened it till the end of this year. Now, on top of these three packages, we also had, or the Governing Council also expressed forward guidance on both the APP, and this is the current formulation. So basically, you can read this also in last week's introductory statement by President Draghi. Our net asset purchases at the current monthly pace of 60 billion are intended to run until the end of December 2017 or beyond, if necessary, and in any case until the Governing Council sees a sustained adjustment in the path of inflation consistent with its inflation aim. So this basically tells you under what conditions we will continue or stop or adjust the asset purchase program. And then there's forward guidance also on interest rates, which is the green part. No? Now I'm talking about the orange and the green part in the previous table on key interest rates, where the Governing Council said we continue to expect them to remain at present levels for an extended period of time and well past the horizon of our net asset purchases. So the two components are linked also in terms of the horizon with which we will apply them. So there's three comments I want to make about this forward guidance. First of all, it's both time and state dependent. For the economists, this is, I guess, quite obvious. Time means that there is a date there, which is December 2017. So there's an intention to continue till 2000, so that's time dependent. But it's also state dependent in the sense that it says, if necessary, we will continue. And what's the condition for continuation? It's really the progress that we're making in terms of achieving our primary objective of price stability. That's what sometimes we call the SAPI criterion, the criterion for having a sustainable adjustment of the path of inflation to our aim of below but close to 2%. And the second thing I want to say is that it embeds a logical sequencing of the various instruments. So the way we came into this package is basically by first exploring the conventional interest rate, bringing it back to zero, and then going into unconventional territory, uncharted territory, with all its uncertainties. And what this guidance basically says, that the way we probably will go out, we'll just be reverting that sequence. And I think that's logical because the effectiveness and the effects of the non-standard measures are, of course, non-standard, and for that reason also more uncertain. Okay, I should keep track of time, which I don't. All right. So, okay, so this is what I want to say about the rationale and sort of the features of this easing package. Two waves, quite comprehensive, three-pronged approach with an important emphasis also on forward guidance. Reason why forward guidance is important, because of course expectations of easy financial conditions in the future will have an impact on asset prices and interest rates now, and thereby also help easing financial conditions and stimulating the economy. Now in this second part, I want to try to convince you that these measures have had an impact as we intended. I'm not saying that we sort of precisely predicted what their effects would be. In a number of ways, their effects were stronger than I think ex ante we have expected. In a number of other ways, they were maybe less effective. But basically, what I want the picture I want to give is about its effectiveness. It's difficult to be very precise about the contribution of the various instruments because, of course, many cases they were taken at the same time, and it's very difficult to identify which of those elements now had the effect that we see. But what is important to realize is that the implementation of those various instruments basically has allowed to activate different transmission channels, which is particularly important in a still partially segmented financial system and banking market. Now, typically, why is it sufficient for a central bank to only move the short-term interest rate? Because if the market, the financial market works perfectly, arbitrage will basically make sure that that easing of conditions in the money market, the overnight money market, gets spread in all other markets. After a financial crisis, in a monetary union where the financial integration is not yet perfect, obviously you cannot necessarily fully assume that that's the case. And again, having the different channels basically allows you to address different areas. The negative interest rate policy and the forward guidance in particular had a significant impact on the future path of riskless interest rates, of current and near-term risk-free term structure, which of course is the benchmark for all other rates, and is mostly targeted at the short to medium term end of the term structure and the exchange rate. The asset purchases of sovereign bonds and corporate bonds complement these policies by compressing term premium, so you basically bring down long-term interest rates, and that way also create portfolio rebalancing effects. So investors, households switching from assets that have become relatively more expensive to assets that have become relatively less expensive, and thereby spreading the easing of financial conditions across assets. And the TLTROs, they were particularly effective in reactivating the bank lending channel, especially in the vulnerable countries, as I will show in a minute. So to some extent, this three-pronged approach allowed us to address different parts of the easing of financial conditions. Another reason why it's not that easy is because, of course, our models that we used until the financial crisis were not particularly well equipped to address financial markets. Typically, the assumption was exactly that financial markets are working perfectly, and so they are a veil. We can ignore them. Of course, less, I mean, it was very clear after finance this was no longer the case. And so at the same time as we have to do policy, or the Governing Council has to make policy decisions, we also had to reinvent our frameworks in order to address how these unconventional measures may impact the economy. And I'm not going to go through this slide. This is the only one where I have an equation, I realize. But basically, just to tell you, we use two approaches. One approach is to try to analyze clearly what the effects are of our measures on financial markets, and then use our standard models to see what that easing of financial conditions means for the economy. And so that way, you have a two-step approach. Another approach is more a direct approach where we try to change our models so that there is a meaningful transmission channel also through financial markets. And here there's just a number of references of the type of mechanisms that we've looked into it. The reason why I just give you this slide very quickly is basically to say, first of all, there is a lot of uncertainty about the effects, and you will see that in some of the things I will show. But secondly, we try to be robust by using different ways of calculating those effects, and more or less, while the sort of degree of uncertainty is relatively hard, we get sort of similar effects, which are also comparable with some of the research done for the US and other countries than the euro area. Okay, so what I want to do next is basically show you a number of changes in financial conditions over the period from 2014 to now, and suggest that a big part of those changes was due to our policies. What this graph shows is basically the shift in the yield curve. So you have interest rates 1 year to 10 years. For the riskless rate, which is the OIS rate, so that's closest we can get in the euro area to sort of a riskless term structure, and for sort of an average of the sovereign bond in the euro area. So what you see is two things. First of all, if we look at the sovereign bonds, which is the blue ones, you see a shift down, so easing of interest rates, and a flattening, right? So that's the main effect. Now, these the last numbers are really from 17th of July, so it's very recently. Obviously, there has been quite a bit of variation over these 2 years, and if you would do this a month ago, it would be much flatter and a little bit lower. If you would do it after the so-called Bund tantrum, then it would be a bit higher. But the main point remains the same, that there has been a significant fall and flattening of the yield curve. Now the question is, well, is this due to our monetary policy measure, or is this due to market or other factors? And for that we need to do detailed studies, and we've done, I mean, the fine print basically gives you the references, but what this graph shows is the estimated impact of our comprehensive easing package on a number of interest rates and the exchange rate. So, for example, this basically says that the estimated impact of our measures was to lower by 150 basis points the average euro area 10-year yield. It was to lower by 80 basis points the riskless 10-year yield, by much less the 1-year yield, because remember, we were already close to zero. 80 basis points approximately for bank bonds, for corporate bonds, and it led to an exchange rate depreciation of the order of 12 to 13%. The diamonds here show you the I mean, this is just to show the sort of degree of magnitude, the overall change in those prices over this period, right? So you see that if you actually look at the current change, where of course there has been some repricing, actually the effects have been larger than what we see at the moment. And again, to show you that it's important to sort of think of this as a comprehensive package of measures that complement each other, what in this graph is shown is the effect. We are comparing the effect of a 10 basis point interest rate cut into negative territory with the effect of a 300 billion additional increase in APP purchases, or in asset purchases. And this is for the US, the effect of QE on. So what you see is that, and the effects are on, again, on the term structure. So I have 2-year, 5-year, 10-year yields. These are OIS yields. You see an easing of policy through asset purchases has the largest effect, as you would expect, on 10-year yields, so on the term premium. No, that's really what it has. Some effect also on 2 years, but much less, because of course there the room for maneuver is much less. This type of pattern is very similar to what people have estimated for the US, similar size. The 10 basis point cut in nominal interest rates basically leads to a belly-shaped reaction of the term structure. No, obviously it has a large impact on the immediate rate. I mean, in this case, it's about 9 basis points. It's a 10 basis point cut in the deposit rate, but it affects relatively more the near-term interest rates, and relatively less 10-year yields. So again, this is based on event studies where we try to precisely see what the news was and how markets responded. Again, by combining the two, you can have sort of complement these measures and have a complementary effect. Actually, let me skip this graph and say a few words about the effectiveness of the TLTROs, the targeted long-term refinancing operations. So I showed you this picture whereby the easing of standard monetary policy was not really followed by easing of bank lending rates, for example, in Italy. No, basically there's no change. Whereas, of course, for Germany, you had a quite nice response to the easing of what you see after the start of our easing package is two things. First of all, the rates drop. So bank lending rates drop, as I showed you before, and on average by 80 basis points. But secondly, they lead to convergence. I mean, there's still differences, and this is what you would expect, because risks are not exactly the same. But this impairment, whereby our measures are not translated to some bank lending rates in some regions, is basically addressed, and you do see an even larger drop in countries like Italy and Spain. This is for bank lending rates to corporates. This is for bank lending rates to households, where the issue was a bit less acute. So the reason why the targeted LTRO was addressed to credit to the non-financial corporate sector was exactly because the issue was biggest in the corporate sector, much less in the household sector. Okay, so this is financial conditions. Now, of course, that's one thing. Then you would expect that this also leads to more credit. No? Credit, the demand for credit increases. And this is exactly what we have been seeing. So this shows credit growth. I think it's to NFCs. Again, before the easing package, with the exception of France, which is the blue line, which has a small positive growth rate at that time. Basically in all countries there was negative credit growth at that time. And as the package is implemented, and again the TLTRO here is a key element of the package, we see a recovery of credit growth. This is driven, of course, partly by the fact that bank lending rates drop, and so the demand for credit increases. And this is something that we also see in our bank lending survey. So the demand for loans was negative, according to the loan officers of banks, before our package, and then became positive after. And the dark blue line here gives you the easing of other bank lending conditions. So they were tight, particularly following the sovereign debt crisis, and then became easier following our package. So the picture I want to show is a comprehensive package of measures that leads to an easing of financial conditions, starts to reinvigorate credit growth, and of course leads to a stronger economy. And this is of course the last, well, no, the one but last part of the chain. Before we get there, let me just show you one piece of research where we look at micro data, basically bank data, and try to see whether you see actually a difference between banks that have used our facility, that have borrowed from the TLTRO, and banks that don't, in terms of the actual credit they gave to the corporate sector. And these two panels give you the difference between vulnerable countries and less vulnerable countries. I mean, basically this is France and Germany. In both cases, you see that those banks that borrowed from us actually did have a cumulative increase in credit growth relative to those that did not. The difference between vulnerable and non-vulnerable is that in the vulnerable countries, of course, there was a deleveraging process going on, and what the measures did was to make that deleverage process less acute. This is more correlation than proof, but there is also research that tries to basically get at the issue of causality through more sort of sophisticated methodologies. And then the final thing I want to say about the sort of the components is that the various instruments have also reinforced each other. So the fact that banks had to pay a negative interest rate, were charged for keeping their cash with the ECB, basically encouraged them to search for higher yielding assets. So there's this complementarity between a small charge on excess liquidity and invigorating the portfolio balance effects that we would expect from the asset purchase program. Similarly, the fact that we had an asset purchase program strengthened the forward guidance on interest rates through its signaling effect. There's quite a bit of research, one by one of my colleagues, Michael Ehrman and other colleagues, which shows that forward guidance, basically telling the market that interest rates will stay low for quite some time, is more credible and more effective when you also have an asset purchase program running. There's maybe a number of reasons why this is the case. One is sort of the simple case that if you put your money where your mouth is, then probably you are more serious and more credible. And the third sort of complementarity is between the TLTROs and of course the other measures. If your transmission mechanism doesn't work, then I mean you can move your instrument as much as you want, it won't have an effect. By having the TLTROs, we basically addressed those impairments, particularly in the vulnerable countries, and we facilitated also the pass-through of our other measures. Now what about then the next step, growth? No? Because in the end, that is, you go from financial conditions to credit to growth, demand to inflation. This is maybe probably too complicated again for this, but basically this shows you annual growth rate for the euro area since 2008, and the different components, whether it's domestic demand, net trade, or changes in inventories. So what you see here is this little blip, that I talked about, the fact that there was this incipient deterioration in the economic outlook in an environment where inflation was dropping very quickly and there was increasing deflation risks. Following our package, basically growth, which was fragile, not broad-based, became stronger and more broad-based. And what is important also to note is that it's domestic demand driven. So it's really because of domestic factors. This is particularly important because, as I said before, in 2016, it was one of the major slowdowns in global growth. Nevertheless, I mean, there's a little bit of a blip here, but growth in the euro area was not materially affected. So our policies, and of course there's also the fall in the price of oil, basically robustified the recovery in the face of such a slowdown in global growth. What this picture, actually let me just skip this one. This just wants to say that indeed there was also a more broad-based recovery. Now basically all sectors or countries that you look at are growing. Now then finally we come at inflation, because that's our mandate, that's where we started. And there's again many ways of showing what sort of has happened between beginning of 2014 and now. But this is one graph that tries to show that the deflation risks which were there at the beginning of 2015, so this is January 2015, that's sort of this yellow distribution. So the mass below zero is basically the probability that inflation would be below zero, so that you would have deflation. The blue one is one of the most recent ones, so that's 18 July. So it has shifted to the right. So average, if the mode, it's still not very close to 2%, but at least it's much further away from zero and above 1%. But what is important is that the probability of deflation risks has almost disappeared. Now, in these last couple of graphs, I again showed you the average, no, not the average, the change over this 2 to 3 year period. How do we know that monetary policy had something to do with it? Again, that's where analysis enters. And so here I just wanted to show you, based on the methodologies that I mentioned before, a counterfactual. The graph here, if we look at growth, and this is inflation, this is growth. So this is the double dip following the sovereign debt crisis and the recovery. And these are our projections for growth from the June 2017 BMPE. The red diamonds basically give you a counterfactual, what would have happened if we had not implemented this comprehensive package. Again, you may believe that or may not believe it. There's a lot of uncertainty around the estimates, but it's based on all the work that I already showed. And there's a lot of uncertainty, no? So this is the uncertainty band. But basically, if you take the median, so the median effect that we estimate using all these different methodologies, then we would say that about half of the growth in 2016 of last year was due to our policies. If you translate that into jobs, it's a couple of million of jobs. And of course, there's also some effect in 2017 and expected effect in 2018. Similarly, for inflation, inflation would have been negative without our measures and would have been quite a bit lower than it currently is forecasted to be for 2017. Okay, long-term inflation expectations have remained anchored, which is a key importance for the effectiveness of policy, although there are some discussions always about the relevance of market-based long-term inflation expectations, which seem to be driven quite a bit also by global development. So they came down. They have stabilized and gone up a little bit, but are still not close to 2%, whereas the survey expectations are very close to 2%. These are 5-year ahead inflation expectations. Now, so what, again, this is just maybe to summarize, go back to the picture that is the most important given our mandate, the inflation picture. So if you look, what has happened is that headline inflation has increased to a large extent because of oil price increases. Unfortunately, core inflation has not moved a lot. And this is really where some of the communication about underlying measures of underlying inflation still being subdued comes from. Now, what is the source of the fact that this adjustment of inflation seems to be very slow? I mean, in the end, this program started in 2014. We managed, as I tried to show, to reduce deflation risks, but underlying inflation does remain very subdued. And this is where, in the last part, and probably I need to cut this short, I have a few graphs on wages, because a big part of underlying inflation, and particularly of the core inflation numbers, the red ones, are services price inflation, which are quite closely associated also with wage inflation. Services are, at least some parts of the services are some of the more labor-intensive sectors. There is a lot of work that is being done to better explain why wage inflation is still so subdued, in spite of the fact that employment growth for the euro area has been much higher than expected. I mean, this is one measure of wage inflation. Well, it's actually the change in wage inflation since 2011. You see that it is still very low. I mean, there's not much of a pickup. According to our model, one of our models, because of the fall in unemployment during the recovery, inflation should have picked up a bit more. There is this yellow part here, which is basically, some call it second round effects, the fact that inflation, headline inflation was low before because of low oil prices, and this is feeding through into inflation. But there's also still a bit of an unexplained moment here. And again, I don't want to run over time, so what in the slides that follow here is shown is a number of factors that may explain why temporarily wage inflation is more subdued than we may have expected. One factor which this is supposed to, I'm not gonna sort of talk about it, which this slide is supposed to show is positive labor supply developments. What we have seen in the euro area is that actually participation rates have increased all through the crisis, very much in contrast to what you see in the US. And of course, in a country like this, in Germany, migration and employment growth for non-German nationals, which are these colored parts here. The yellow is the Germans, has been an important part of employment growth. Of course, if there's more labor coming in, then everything else equal, you will get more employment. It's like a labor supply shock, more employment growth, less pressure on wages. A second element is, of course, the ongoing adjustment in imbalances and relative competitive positions within the euro area. You've seen these graphs before. I think this institute has shown variants of this many times, with sort of the deterioration of competitiveness. This is unit labor costs in a number of countries relative to Germany, which is the blue one, and then of the need to adjust, no? Which leads to a situation where wage inflation is much lower in those countries, vulnerable countries that need to adjust, and relatively higher in Germany. As a result, if you combine that with labor market reforms that are taking place, have taken place in the vulnerable countries, the adjustment of the negative wage disinflation is stronger than the adjustment of the positive wage inflation that you may want to see in the core countries. As a result, most of the changes in unit labor costs are driven by the core countries. There's no contribution coming from the vulnerable countries. A third factor is composition effects. The composition of employment growth has changed. It is much more now into services, much less in obviously construction and industry. It's much more recently actually in the older parts of the population, much less with the youth, which is of course an issue for youth unemployment. And this is where I want to sort of end. But probably the most important factor, so there's a number of factors you can think of: structural reforms, globalization, composition effects, positive labor supply developments, immigration. But the bottom line is that there's still quite a bit of slack in the economy. And this is basically what I want to show in this last economy. And again, I'm talking about the euro area. No, this is what our mandate is about. What this shows is unemployment rate normalized to be 0 at, I guess, in 2006. That's the blue line. And of course here you see that starting in the second half of 2013, basically unemployment rate has been, this is the gap, no? So it's kind of the reverse of the unemployment rate. What you've seen is that the unemployment rate has been falling, or the unemployment gap has been rising, has become less negative. But, and this is the yellow part, if you take a broader notion of the unemployment rate, you get sort of a bigger gap. And basically what is this broader? It's people that are only marginally attached to the labor force on the one hand, and it's on the other hand people that work part-time on an involuntary basis, that would like to work full-time but cannot work part-time. So these are sort of sources of unutilized resources that you won't find in the usual headline unemployment rates. And it's normal that in a recession basically this increases or decreases more than the headline inflation, but you also see that basically this gap is converging, but at a slower pace so there's still a bit of gap here. If you compare that with the US, just to show that we're not very different in this respect from the US, so we have similar measures. The dark blue line is like our unemployment rate. The blue, so the light blue line is like the yellow rate. And this is where the US now. So basically US is, according to this measure, an economy of full employment in the labor market. Nevertheless, wage inflation, I mean, now is starting to pick up, but it's more or less sort of consistent with the Fed's inflation objective. So if you take this as a benchmark, there's still some way to go to sort of use up the unutilized resources that are still in the labor market. And one way of seeing that is just by showing you a very simple Phillips curve. So this has this broad unemployment rate on this axis and compensation per employee, our wage inflation measure, on the vertical axis. So in the crisis, of course, this is the boom just before the crisis. Then from 2008 to 2011, the first part, you got, of course, unemployment increased, no? And so you go down the Phillips curve. Then there's a little bit of the recovery after the first dip. Then the second dip, where you have the second, which is more or less what I talked about mostly. And so the recovery that we've seen is basically this line. And see, I mean, this is, of course, it's not, it's eyeball econometrics, but what you see is we're still in sort of the part of the Phillips curve, which is relatively flat. And of course, the hope is that as the economy continues to recover, basically also wage inflation will recover. So basically, that's what I wanted to present to you. I mean, where does that leave us in terms of the current Governing Council's discussions? I mean, maybe I can just sort of repeat two sentences which come from the introductory statement that the President gave just last week. The first one is, while the ongoing expansion provides confidence that inflation will gradually evolve to levels in line with our inflation aim, it has yet to translate into stronger inflation dynamics. And one of the things I try to show you is that basically to illustrate this happening. And the second sentence is, as a result, a very substantial degree of monetary accommodation is still needed for underlying inflation pressures to build up. And so if I want to translate those two sentences, in fact, you can translate it into the two terms that also President Draghi has used about, on the one hand, confidence that our measures are working, and I hope I have maybe not convince you, but at least show you some evidence that this is the case. But on the other hand, also patience and persistence to actually let them work, so that in the medium term, as you can see, we have a sustainable adjustment of the inflation path to our aim. So thank you.